Everything that's said on this event is for educational purposes only. Nothing should be considered a buy or sell recommendation. Always check with your registered investment professional before making any investment decisions. That's pretty much it. We're not going to get personalized or individualized investment advice, but we are going to, for educational purposes, discuss a few stocks to avoid like the plague, because there's going to be some big mistakes being made here today. Let me go to the Transformity Investor Bank Crisis Emergency Webinar with me, Chris Rowe. I'm the founder and CEO of True Market Insiders, and Tobin Smith, the legendary analyst and very cool guy, man about town.
Legendary means old, Rowe. I don't like that.
I won't call you old anymore, I promise. I'll just call you Mr. Miyagi.
There you go. There you go.
Okay. So for those of you that don't know, Tobin Smith, among many other things, I mean, he's a research analyst. He's got lots of major fund managers around the world that look to him for guidance and advice, direction. And he's a thinker, and he's somebody he's kind of like Yoda, he teaches the Jedis. And he's a very valuable asset among the hedge fund community. Spent 14 years on Fox News. I think it might have been 15 years. And Fox Business is a market analyst anchor and host of a very famous show, Bulls and Bears. It was on every weekend. And after leaving Fox, Tobin went on to launch this very successful investment newsletter service. It's actually the most successful one in the entire industry. He was the biggest financial publisher / financial research firm, including the Garazelli Report and Change Wave Research. The late, great Steve Jobs, founder of Apple, once said, when asked about which research firm had gotten Apple right most often, he said, without a doubt, Tobin Smith's Change Wave Research. This is coming from Steve Jobs. He goes on to say, they were the first major research firm to get the iPod and really understand the iPhone. So Tobin's groundbreaking research didn't stop with the iPod and the iPhone. His early and accurate analysis of next big things that transformed industries and technology and created thousands of new millionaires. Tobin's historic market top and market bottom calls in 2000 and then 2003 and 2009, and deadly accurate macroeconomic recession and expansion forecasts that made and saved his subscribers billions. Legendary stock picks, including Sirius Satellite Radio in 2002, Amazon in 2003, Apple 2005, Pioneer Energy 2006, Gilead Sciences 2013, NVIDIA, Amazon, Netflix, AMD, and Micron in 2015. He also gave his readers possible life-changing buy and sell recommendations with a 40.8% average annual returns from 2000 to 2010 and 50.1% annual returns 2013 to 2017. Tobin Smith is the author, no surprise, of a New York Times bestsellers, Change Wave Investing, Change Wave Investing 2.0, Billion-Dollar Green, Profit from the Eco-Revolution, and finally, Foxocracy. So I'm very excited to be working with Tobin Smith here at True Market Insiders. You've spoken to some of the biggest, smartest, most informed investors on Wall Street throughout your career, and you've not changed that anytime recently. So we are in luck to have you here because we've got a fast moving market. There's new news coming out on this seems like every 20 minutes or so. I think you just informed me that about 40 minutes or so ago, the Federal Reserve said that they're going to do an investigation.
I'm shocked.
Yeah.
They're going to do an investigation.
They want answers, right?
On something that a blind dog with a note tied around its neck could have figured out. Mm-hmm. I mean, this is Chris. This is going to be heads are rolling, and they should.
Yeah. Well, it's always the people that you could pretty much tie this back to and blame largely that bark the loudest and say that they want answers and investigations. I'm looking at the Federal Reserve. Any additional rate hikes that they do from here on out. I heard Josh Brown say earlier today, made a great point. He said that's the first rate cut that they're going to have to throw right back at us. And they did too much too quickly. There's a lot of other banks out there that are obviously highly leveraged, just a matter of time. What this does for confidence is terrible. This is going to be in everybody's memory, and people are going to get hurt. I don't want to talk. I want you to be the guy who talks here. I want to get right down to it. I'm going to dive into some of the questions that we have here from some of the subscribers, and more importantly, we're going to get into some of the things that we promised that we would discuss. I think first, let's start with basics. I mean, to me, this is a bailout, a little bit different from 2008, but it's a bailout. Venture capital community and their companies, their investments. Why don't you explain to everybody, just so that they understand clearly, what's going on? Why is there a banking crisis right now, front to back?
Yeah, well, Chris, the news has come so fast. What's intriguing, number one, is just simply that banking is a fancy term for being in the confidence business. You deposit money in a bank or in a brokerage firm, et cetera, and that's an act of confidence that you're placing into someone else. And particularly when it comes to people's money, particularly $250,000 of people's money or more, when you are driving home and you hear that your deposits at the Silicon Valley Bank are locked up and that they're going to be going bankrupt in a day, that'll shake a lot of people. And then when you shake confidence, Chris, then it reminds me of the time that I was with Fox News and reporting on the meeting that they were having at the Senate chambers, where Hank Paulson was here and Ben Bernanke was here, and they had Senator Trent Lott, who was a good friend, and he had invited me to come in, and they locked everybody out, and they threw everybody who wasn't a senator or a congressman out. And they came in, and Hank Paulson basically made the famous speech that, ladies and gentlemen, if you do not approve this TARP plan, it was his plan, by the way, soup the nuts. If you do not do this, then on Friday, this is Wednesday now, on Monday following this meeting, your constituents are not going to be able to get money out of an ATM. It's going to be locked up. And you're going to have riots on the street. And when those guys walked out, men and women, I have never, you talk about seeing a ghost. It looked like someone threw white powder on their faces. They were scared to death. No one had really looked them in the eye and told them what was going on in 2008. Well, today is not that day. We are not in TARP land. There is no TARP here. Let's be clear about that. We have this thing called the Federal Deposit Insurance Corporation, FDIC. And the FDIC, every time a bank takes a deposit, they pay a fee to the FDIC into a trust fund. And that trust fund is what's paying off the federally insured money accounts. But if you step back, and I think people talked about this a lot today, but it is mind-boggling to think that KPMG, the third largest accounting and auditing firm in the world, 28 days ago went through the books in their annual review and gave them a clean bill of health. They gave them a 5-star rating. How is that possible when they had $222 billion wrapped up in higher yielding mortgage securities and in treasury bonds? But those things, obviously, when interest rates go up, what happens to the value of a bond? It goes down in value because these are fixed rate bonds.
And so isn't that reminiscent of 2008? I mean, you have banks and mortgage companies that are given high ratings, clean bills of health. I mean, this sounds just like 2008.
Well, right. Well, but there's a couple differences. In 2007, 2008, this is actually more like the savings and loan crisis back in the 80s and 90s. Because in the late mid 80s, we had this new tax act, and it was called TEFRA. And all of a sudden, these savings and loans that had loaned to build apartments and homes, and then they got syndicated as tax shelters. When that got taken away, all of a sudden the value of their apartments, if they didn't have a tax value, no tax write-off value, went down 15 or 20% in a day. Mm-hmm. And when that happened, the savings and loans, which basically operated on about a 90% leverage basis, they were insolvent. We had 700 savings and loans, and it was blow by blow by. It wasn't just one day, Chris. It took literally 6 years, and I was in the middle of that with Kidder Peabody, and people. If there was Zoom, then you would have had 1,000 people on a Zoom call, all the guys in the savings and loan business, and say, "WTF? Where did this come from?" Mm-hmm. They completely changed the rules on us, And they know that we have leveraged loans on these things, and now those loans are upside down. How is that possible? You know, literally hundreds and hundreds went bankrupt. That's more of what to me that's analogous than 2007, 2008. Yeah, we had the liar loan, you know, mortgages. If you could warm a mirror, you could qualify for a mortgage, right? Mm-hmm. And then, you know, not to get too into the weeds, but people, when they think about the bailout of TARP, et cetera, they think about American banks. But the actual fact of the matter is that when you took those mortgages, and remember, you have a FICO score, so above 700, above 600, 500 to 600. So what happened is this boom took off because the Fed cut rates after the dot-com crisis. You'll notice there's a similarity between that. They cut rates to zero. People lost their ass on dot-com stocks, so they started buying homes, and they could get a 90%, 100% mortgage. They could get a variable rate. I mean, you know, they could qualify for anything. So they bought a home or two. They sold those. They made some money. My favorite story is the strippers in the Vegas strip club would tell you how many houses that they purchased, and how many they were renting, and so on.
I have friends that told me that they heard that.
I'm sorry?
I have friends of mine that told me that they
heard that. Exactly. Friends of mine too.
Yeah.
So what happened was that if people don't understand, if you're like a Bank Paribas in France or Credit Suisse, et cetera, they operate at much higher leverage rates than our United States banks. I mean, basically, you know, United States bank is regulated. If you have $1 billion in deposits, you can only make X amount of loans. But in Europe, Bank Paribas was operating at 70 and 80% leverage, meaning 80 times their deposit base. So if those mortgage rates started falling apart and those securities started dying, then they could only go down like 5% times 80, and these guys were bankrupt. So what's really different about that, you know, bank run was that these securities were packaged by Goldman Sachs and by Bank of America and, you know, so on and so forth, Bear Stearns. So you started with a whole bunch of mortgages. You put them into a package, into an entity. That entity then you sold bonds against. People could get income from it, and then the bonds got a security bond or a surety bond. You know, at this time it was AGI, and then AGI borrowed money to secure the bond. So when you all shook it out, there was maybe 150 times leverage in those mortgage securities. And I did a movie on this called, you know, The Great Depression, and we avoided the Great Depression because of TARP coming and backing things up. But if you looked underneath the covers, you know, AIG wrote $14 trillion of guarantees on these mortgage bonds, and they had about $100 billion to back that up. So it unraveled because of essentially an industry that was created to package all these things. But I'll tell you the other thing that really was different, Chris, is that when I worked for Kidder Peabody, it was before it was bought by General Electric. It was a limited partnership of old guys from New York, basically, and they were all limited partners, but they were at risk. And I can remember being back at a meeting in New York, and I had come up with this great way to buy auto loans, and we were making a bunch of money. And I went back there and said, well, I want to get a $100 million line because Toby was going to make $1 million for originating all this stuff. And they looked at me and they said, you know, hey, Toby, let me ask you something. If this fakakta idea of yours, you know, goes down, are they going to take your house? Are they going to take your vacation home? No, sir, they won't. Well, it will. They'll take mine, and they'll take my second wife's and my third wife's. So they were at risk, and that changed their behavior. The partners who owned it were at risk if this idea went south. When you remove the at-risk part, and that's what happened, you know, in the savings and loan deal, then people will do anything crazy, because here's what really happened then. All these guys had gone public, and Merrill Lynch and Bank of America, all these guys had gone public. And they were getting stock options and making beaucoup money. That 2003, 2007 run. So if they were getting close to not getting their earnings per share for the quarter, they just go down to the accounting office and say, hey, fast forward those mortgage-backed securities and let's recognize all the income now. And that added to everything else, that blew up. Okay, we're not in that situation. They're all public, but they now can't take profits immediately on, you know, in this case, on stuff that they were doing with just simple deposits. The third thing that's different on this one is that we weren't in a rate cycle, a rate hike cycle. We've been in a rate cut cycle, as you know, since 2008, 2009. no one's worked. Most people haven't worked in a rate hike cycle, and that's the only thing that explains to me how the KPMG and the San Francisco Fed just looked at them 45 days ago. That these were like junior accountants and regulators who just didn't ever dawn on them that what happens if the Fed raises Fed fund rates from 0 to quarter point to 5%? If these guys own $224 billion of mortgage-backed securities, fixed rate, and bonds, fixed rate, and guess what? They go down in value. And I don't know, Chris, how someone didn't recognize that. But we created this concept in 2007, 2008 in the great financial recession that we designated a certain amount of banks that were too big to fail. And the definition of too big to fail was if you had over $250 billion of deposits. Well, shockingly, Chris, I know it's going to sound strange, but this bank that just failed was at $224 billion. So they were not part of the regulatory climate.
Wow.
And that's a big mistake that was made to somehow define that a bank at $251 billion can't go out of business, but a bank at $240 billion can go out of business.
Wow.
So that's in a nutshell what has happened. Now,
and their deposits have, I think, tripled just in the last few years, which people would. I think that Silicon Valley Bank (SVB), they were thriving. Their credit losses had been low. Their deposits had tripled from 2019 to 2021. And if anybody were to hear that, they would say that it was a great, solid bank. But
except for one strange thing,
they have to make money on those deposits. Those deposits are cost.
Yeah, they actually financed a winery. By the way, they finance about 70% of the wineries in California, FYI.
Well, what I want to do is I want to get to what the bank failures mean, what you think to the economy, and what you think is going to happen in terms of contagion, and are more bank failures coming? And I think the people at home want to know what they should do to protect themselves, their retirement, their wealth, if something much bigger is coming.
Okay, well, I mean, that's what I'm trying to break down. If the Fed had not come in this weekend, we would be having a completely different conversation, because obviously they not only said that all the deposits are guaranteed under 250,000, but they said all of the deposits over 250,000 were also guaranteed, and that was going to come out of the FDIC. We would have a contagion like nobody's business. I would not be making a statement. This is not like 2007, 2008 if they had not come in and did it. But they've seen this. This is an economic term. They've seen this shit show before. They were prepared for it for the large banks. What they weren't prepared for was the smaller banks. But also they put a regulatory scheme in that was supposed to prevent this. And as I say, a blind dog with a note tied around its neck could walk in and look at those books. Here's another thing. In 2007, 2008, and I've been in now every bank crisis since the 80s. In 2007, 2008, there was this thing called the internet, but there was no software as a service. There was no automatic connection of all your data. Today, the loans that any of these smaller banks make, as well as the large ones, but particularly the smaller ones, they see their balance sheet 24/7, 365. There should be, alarms that went off and said, wait a minute, these guys went from 70 billion to 240 billion. Why? Because, you had this thing called the pandemic, and we had this thing called 440 IPOs, mostly all tech companies. And 45% of those IPOs had a contract relationship with Silicon Valley Bank that said, if you're going to take our money, then you have to bank with us. And and since we introduced you to the investment bank and we participated in the underwriting, you have to keep your money with us. Well, this was all visible, yet how were so many people blind? And Chris, I think that's the question that until we have the answer of, nobody can say that there's not going to be other, blown up banks. I guarantee you there will be. It's just that, in one way, this is like the first Twitter-led bank panic. When I'm on Twitter on Wednesday and I'm looking up, Silicon Valley, hashtag Silicon Valley Bank, I'm seeing all these VCs on Twitter telling the companies that they've financed, run, don't walk, and remove your money from Silicon Valley Bank. Now, we didn't have Twitter in 2007, 2008. I mean, so this is a somewhat, unique situation, but it's just the same thing all over again, just with different characters. If a bank takes risk, interest rate risk, what banks do, and the reason why that there's a thing called hedging, is that you pledge those securities to an investment bank or a large B of A bank, Citibank, et cetera, and then they create a swap, it's called. And that swap says that you fixed your rate, that the bank is taking the interest rate risk. The large bank who's issuing the swap. They didn't do that. Why they didn't do that is beyond anybody's imagination. But we had regulatory failure. We had risk management failure. They had 5% of their money in an ESG fund that was buying green bond funds. What? So there's a lot of blame to be put here. But again, if the Fed had not come in and essentially covered everything, then we'd be now on Monday. Well, what happened? Monday, any bank that looked or smelled or looked like this, got crushed. And some of those will not survive. I mean, they're not going to survive simply because they're going to lose personnel because their stock options are worthless, and regulatory costs are going to go up.
Yeah, absolutely. And there's definitely going to be more losers, and there's going to be some winners too. I heard that J.P. Morgan, for about a week leading up to this crisis, was soliciting a lot of the clients from SVB, kind of preparing them, and other big name banks as well. So there's going to be very similar to 2008, where J.P. Morgan got to take the assets of Bear Stearns, guaranteed by us or the Federal Reserve, however you look at it.
Right.
Something like that will be happening here. So there will be some winners from all this, and the losers are going to be the ones that are not hedged, as you said, with swaps and things like that. And just so everybody understands, even though SVB got, I guess they tripled their deposits from 2019 to 2021. What they have to do then with those deposits is they have to lend them out, or they have to put them somewhere, because what they're doing is they're paying interest, and they're also paying the cost of running the banks. So they have to make money on those deposits. It becomes it is a liability as soon as they get that deposit. And when rates rise, fixed income prices fall. And when deposits were pouring in too fast to lend responsibly, SVB recognized that. And rather than make dumb loans, they bought assets guaranteed by the U.S. Treasury, by the U.S. government, treasuries, mortgage-backed securities, long duration. So about 10 years out, 10-year plus out. When rates rise, we said fixed income prices fall. So if you have a rule of thumb, for every 1 year of duration, each 1% interest rate move impacts the price of the bond by 1% times duration. So basically a 1% move on a 9-year duration would be about a 9% change in the price of the bond. And since these banks are levered, they're using so much leverage. If they're levered 10 to 1, if they see a 10% decline in the bond, that's a 100% wipeout of their position. So when you have the Federal Reserve out there raising rates like this, to quote Bill Bonner, he recently said that the Federal Reserve will raise rates until they break something, or until something breaks, and then they will probably pull back.
I wouldn't credit that to Bill Bonner. That started about 1975, but be that.
Well, he was around in 1975. Well, I think what people want to know right now is what to watch out for. Let's start giving some names of some banks, or whether it's a bank or not, players to watch out for, stocks to avoid. And if you have anything on companies that will benefit from this, or will likely benefit from it, we'd like to share those with everybody. I'll pull up the chart. And
and you're the chart master, so you get the charts going.
And I already have PNC pulled up, because we had a discussion about this yesterday, and you were talking about PNC, and I believe what you were saying was that they might be a company that will make an acquisition. They're perhaps a company that's being unfairly punished, because as far as you could tell, they have a pretty strong balance sheet. Am I remembering that correctly?
Yeah. Well, let's go to the broad big picture here. In this type of manic sell-off, all of the banks above $250 billion, the major ones, the Citibanks, the JP Morgans, et cetera, they came down a couple of percent. Why? Because they've been given this golden image that they're too big to fail. So you're not going to bet on them failing, Chris, if they're too big to fail, and it's in regulatory rules. So you go to the super regionals, and the super regionals are in many ways the working horses of American commerce. With my little company, we wouldn't be with J.P. Morgan Chase necessarily. We got no juice from them, but we go with a local bank here who gives you credit lines and guarantees and so on and so forth. Because I'm too small for J.P. Morgan, right? So the super regionals are the ones that will deal with smaller companies, $5 million, $10 million a year type companies. And what I really like about PNC is they are the absolute dominant player in fast growing areas. Believe it or not. Pittsburgh is a fast-growing area. Look at that chart, by the way. They are, huge in the left to right. Wow. So they are extremely conservatively run. They're extremely conservatively hedged. Their earnings per share are growing still at about a 12 to 15% rate. They are acquiring banks, and they'll acquire more banks. I think they've done 12 or 13 acquisitions, and they're going to be the ones who are going to be buying the guys who can't make it any longer. Because Chris, the Fed is not going to allow J.P. Morgan and Bank of America and Citibank to buy small banks now. They don't want that concentration. So they're going to let the strong regional, well-managed, risk-managed guys buy it. And that to me looked like the bottom. I think we were looking there at 133. We were a buyer down there. I think we got it about $133. I think it rapidly gets back to the 190 level as more clarity comes to the marketplace, and they will make acquisitions. There's another bank very similar in my old haunting grounds of Washington, D.C. and Northern Virginia. Was a combination of a bunch of banks. It's now called Truist, TRU, or TRC, I think is the ticker symbol. And Truist is sort of like a clone of PBC in that they have been very successful in their acquisitions. They also have a brokerage, and they just got crushed. And I think they got crushed a little bit because of the problems that Charles Schwab had. One of the most amazing things on Friday and really on Monday was how Charles Schwab got smacked 35-40%. Now, I know them quite well, the CFO, then their international senior vice president. I was just with at the Super Bowl a couple of weeks ago here. And what's intriguing about Truist and Schwab, and Schwab is now on our buy list too, by the way, is that the idea was, the problem was that, and if you're investors, if you have an account at Schwab, do you carry your cash in your brokerage account, or do you buy a money market fund that's paying about 4.5%? Well, and the same thing at Interactive Broker, except Interactive Broker pays 4.5% in your cash account, and you don't have to buy a mutual fund. So that's why another reason why we like Interactive Broker here. But Charles Schwab is the most conservative. They are the best financed. They have more liquidity than any. They have a bank and they have a brokerage, and they're completely separate. One's SIPC, and one is FDIC. And for them to just be crushed 30%, when in fact, if you talk, I was texting with one of my contacts there. They've been taking in on Friday. They took in $4 billion of new money. They've been taking in on average $2 billion since this whole caca hit the fan.
Right, because when people are worried about their deposits at the weaker banks or the banks that they don't feel confidence in, they just move their deposits to other banks that they think the government will bail out. So when something like this happens, you see a lot of those big banks grow a lot larger in terms of their deposits.
Yeah, and bear in mind, I mean, here's another thing that's unique about today that wasn't in 2007, wasn't in the bank. I don't have my phone here. Oh yeah, I have a phone. It has a Bank of America account, credit line, et cetera, et cetera. If I felt that Bank of America was going to have problems, I would wire money out of here in about 10 seconds. This is the first time in history that 80% of the funds that were removed were wired out of account from a banking app. Now, that brings terror to some people, particularly when I was a bank president. But actually, this is what's keeping their nose clean. Now everybody understands that the interest rate risk means something. And when your customers, I mean, even my 85-year-old neighbor who down here, I set her up on a B of A on her iPad. She's got a lot of money there, Chris, let me tell you that. And when she called me yesterday and said, Toby, do I need to move my money out of B of A? I said, no, you do not. Do I need to move my money out of Schwab? No, you do not. So this really changed the dynamics. This is why this thing crushed in 2 days. Twitter and the bank app was never involved in anything we've done before. So that dynamic has changed the world. And if there's other banks that have a high amount of deposits, that they've invested those deposits in fixed rate mortgage securities because they were paying like 4 to 4.5%, and the deposits only cost them 25 basis points, a quarter of 1%. Then those guys are going to get they're going to get phoned to death too. They're going to get apped instead of aped. They're going to get apped, and that's just that's life in a big city, Chris.
So I'm just going to do a quick review here. So far, the stocks that we've mentioned for everybody at home who's writing this down, because it's a very fast-moving story, and it's important that everybody that showed up tonight made it here to the live event, because a lot of this stuff you could use at the open tomorrow. So we have Charles Schwab, SCHW.
Yep.
You mentioned IBKR, Interactive Brokers.
Yep.
PNC.
Look what happened to them. They came down just a little bit.
Yeah.
And they're going to get a ton of money. I texted with our brokers down there, and they said that they took in almost $13 billion in the last 3 days.
Yeah. So if you think about that, and you look at the stocks chart, it's important for everybody to remember that there's what's happening to the price of the stock, and then there's what's actually happening at the company. A lot of these bigger names, they might get sold off in the mix down on sympathy with the sector. They might be sold off by the index fund traders that are just selling all financials. But it's going to create an opportunity in the strong banks that are going to benefit from this, while the other ones lose, perhaps their companies. So you have Charles Schwab, SCHW, as a healthy company that's benefiting from this. You have IBKR, Interactive Brokers, same story. We mentioned PNC, another strong company. Show the 10-year on PNC. That's a nice one. And we have TFC, Truist.
Yep.
Came down just like the pandemic. I mean, just came straight down.
Right.
And some of these might fall further, but again, you have to know which ones are falling further just because they're down on sympathy, and which ones are falling just because they're companies that took risks that are now the chickens are coming home to roost. Was JP Morgan in the mix? I imagine it must have been.
Well, JP Morgan is a beneficiary. Again, any of the too big to fail banks, the SPSK banks, are going to benefit from this. But the Fed, now realizes that if the top 10 banks that control 60% or 70% of all deposits, they don't want them that concentrated, Chris, either.
Mm-hmm.
I mean, they want risk. They want to spread the risk. Citibank's not going to do that much from this because they're much more international at this point. So the Citibank is of no interest to me. JP Morgan came down a little bit if you put that up. I mean, it came down, but look, it recovered half of its losses, quickly.
Right.
And if you look at the ceiling on that chart, they're pretty, fairly valued as you get into that, I think it's the $150 range. So I'm more interested in buying and owning the regionals and the specialty guys that have more room to go up to the upside, and we'll be doing acquisitions because this thing's going to play out over many months. It's going to play out into next year. I mean, there's another issue here that was just mind-blowing to me. When a week ago, if we had this conversation a week ago, the Fed futures were predicting that the Fed's terminal rate, the point where they were going to, quit raising rates, was 5.75%. That's what it was on Tuesday a week ago. Today, that number is 4.5. I've never seen that. There's never been a drop like that. Mm-hmm. Now, what that means is that let me back up just a little bit. There's other small niches that we love at the right time. So if anybody out there is familiar with a mortgage REIT buys government mortgages with leverage. NLY is a good example, Chris, NLI. And they provide a very high yield. NLI right now probably has a 14-15% yield. We do not own, and that's legit. I mean, they're not doing anything crazy with it.
14-15% yield. This is paying.
Yes, because they
get paid 14-15%.
Yeah, because they are borrowing 80% of the money to buy the mortgage paper, which is 100% guaranteed by the government. If they ever need to turn it, they can sell it in a 5 seconds because there's a $1 trillion market for mortgage-backed securities. But you buy them. Go to a longer look because let me show you what I mean. We go back, 10 years. Okay, so we see that dot at the pandemic. Yeah, we bought it into there. They were being priced as if they were going bankrupt. And when they came back to normal, we sold it. We generated, very nice yields. We actually bought some options and then sold put options on that. But when rates start to go up, the stock value goes down. Why? Because they own these fixed rate mortgages. Go back a little bit more. Let's go back to the Great Recession because Analy's been around for a long time. We made a lot of money back here, and then again they were like $20 to $70, et cetera. And then look at this thing; it's coming straight down. You don't want to own them when the Fed is cutting rates.
When the Fed is cutting rates, or when the Fed is raising
rates? I'm sorry. Too many phone calls today. Too many jams. Yeah, you don't want to own those because the securities they own are going down in value.
Right. When the Fed's raising rates, the securities that they own are going down.
But if you look at those two bottoms, that double bottom there, as soon as we get the Fed says, hey, we're done raising, we're going to buy Annaly mortgage because the rates, the dividend will be amazing. Then we reinvest those dividends because now you're building a lower cost basis, and all of a sudden, the last time we did this, it was pretty spectacular. So there's timing, and timing is important when you're talking about interest-bearing securities. And since everybody's forgotten about the business cycle and the Fed cycle, since we didn't have one for 14 years, now we're in a cycle. We're in a business cycle. The third thing you're going to see, Chris, and you're already starting to see it, is you'll notice that the 150 employees that we have here at TMI all are work from home, from a non-office. Well, multiply that by San Francisco, Manhattan, Chicago. I mean, Houston's a different story because you got old business down there, so they're filled to the brim and they have great healthcare. But we're negative. We've been short these city office, CIO, OPI, Orion office. Don't fall for the high yields on these office REITs. The Pacific Life, like the third largest life insurance company in the world, just defaulted on 3 office buildings, all in Bay Area, of course. But that's not the beginning. There's a guy in New York who I love, Dave Talmadge, who has now got a $2 billion fund with JP Morgan, of which I'm a very tiny investor in. And they're buying Manhattan office buildings like you and I worked in and turning them into condos. And they're paying about a 6% yield. They're going to do an IPO for that as a REIT here in the next 6 months or so. That's a REIT I'd buy. The mortgage REITs I'd buy when we hit peak rates, and we'll know when we pick peak rates because the Fed will say, we're done. And then you buy Annaly mortgage. And there's some other ones that we recommend in our service in the mortgage REITs that pay a little higher yields. Well, but timing is everything, baby.
So what are a couple of issues that they should avoid? What are some stocks that you think might get hit hard because of this?
Well, I mean, there was a lot of, you and I were, you magnificently called the January rally and so on and so forth. And remember that in the January rally, the stuff that rallied the most was the stuff that was 80 to 90% down, right? And there's a lot of reasons for that January effect and the Santa Claus effect and all that shizzle. But the stuff that raced up is now raced down again. And don't think you're going to get that January effect again in March. I mean, as you know, the other stocks that did well over the last couple of days were mega tech. Why? Because they don't need any money. They're sitting on $8.5 trillion of cash. So what happened to the QQQ, Mr. Chartman? We just got our golden cross, where the 50-day has gone up through the 200-day. So I'm not avoiding mega tech, but I'm certainly avoiding any rec tech. And that, I was just looking at like the Real, the Real, and Warby Parker, Nikola, all these things that ran up 300 or 400% in January have all run back because they're dead men walking stocks. And so to buy speculative trash, no earnings type, crazy tech, ex-SPACs, let's put it this way: the stock is trading for $10.02, and you don't know what it does. It's a SPAC, okay? Because that's the amount of cash they have. But we have done very well this year by A, avoiding all this caca. B, if I can brag a little bit, put up the ticker symbol ASC, Ardmore Shipping.
This is one that I've been wanting to buy, and I'm waiting for it to pull back, and it just doesn't pull back. I've been wanting to recommend this to people. Just watching this thing just run away. Bill recommended this in the summer, I think.
Yeah, he did. So here's how transformative research works. You are the king of understanding price action and being able to find stocks that are going up and continue to be staying up until they don't. We work in the reverse. There was this little thing happened in Ukraine. I don't know if you remember that. And then we had this little thing called the boycott of Russian oil. But more importantly, boycott of diesel, boycott of air, of fuel. And when that happened, Russia went out, bought, stole, borrowed, leased about 500 product tanker ships to go out and ship their stuff to the people who will buy from them, which is India and China and a couple other countries. So at that time, shipping, product shipping, oil shipping stuff was down. Remember, I'm sure you remember Zim. I'm sure you owned Zim, with the great container rate increase. That was incredible. The containers went from $3,000 to $84,000 per 30-foot container. And Zim, the stock, talk about a Viagra stock. But, all of a sudden they ran out of juice. Well, we did pretty well with that, not as well as I would have liked. But ASC is a 3 PE stock that just started to pay its dividends. And if you follow the shipping costs for tankers, the shipping rates are up 400% over the last 6 months. And the reason is that if Russia takes 400 ships out of the water, or actually out of the fleets, I should say, and there's no new tankers being built, anything that's being built right now is an LNG or LPG shipper, by the way. Mm-hmm. And now all of a sudden, the other thing about Ardmore is that they sell everything, they rent their stuff on the spot market, meaning they're not doing long-term leases on their boats. They're on the spot market. So all of a sudden, if I'm Shell or BP or Valero or anybody who needs to ship product, they have to pay what Ardmore asks for because they're not going to have a ship otherwise. Mm. So we're still long this. I have a $25 target on it. But it's a good example of our approach, which is to take these transformational changes, secular, not cyclical, transformational changes that create pricing power for the companies and demand from the buyers that's more than supply. And we're in every one of those. We were in the bulk shippers last year. I'm sure you had SBLK in your, because it was like the most beautiful chart in the history of the planet. And they were bulk shippers. So go back 2 years back when China, had not shut down, but all of a sudden we had issues with, pandemic, and everybody needed food and needed to transport stuff and so on and so forth. Their rates, if you go back, their rates just skyrocketed. But they peak. And, the thing you have to understand about like shipping is cyclical. Okay. Mm-hmm. So when those rates skyrocket, you change. But here's the third thing that's important, Chris, about sort of the new world we're living in many industries, the energy space, oil and gas, et cetera. These guys used to, I used to date a girl, okay, who was Greek, and her grandfather was like Chapalopoulos, whatever. And when you go to the parties, they would just try to get the Irish kid drunk on, as much ouzo as possible, right? But I got to know those guys, and many of them were in the shipping business. So here's what the shipping business used to be. I own this ship. We make money. As soon as we make enough money, I'd buy another ship and then another ship because Carlos has more ships than I do. And I hate that son of a gun. And so it was a giant, manhood contest for years, for decades and decades. And so the shipping stocks would go like this. The first time we bought them was when China entered the market in 2001, 2002, and all of a sudden they needed a whole bunch of coal and oil and everything else. We did great until we peaked, and then they crashed. And then we did again when we had the commodity rush, and they did great, and then they crashed. Well, now we have a secular shift that's going to last a lot more days than just a couple years. So Ardmore, but in bulk shippers, again, the prices went sky high. They came down, they bought them. Look at the ticker symbol BDRY. BDRY is the Baltic Dry Index, and look at that chart. What do you think the stocks were doing? When the bulk shippers were, and then boom, and then they ripped, and then they fell. Now, if you look at your support line, we're getting right to that $10 support line. The rates have been up 14 days in a row, 14 trading days. And I think if you put a 20-day or a 50-day moving average, what do you have up there?
That's a 200, but it's on the weekly. So let me go to a daily chart. Now you got the 200 day. I'm gonna also put the 50-day. Yeah. So now you got the 50 and the 200.
Bingo. So we're buying those as well. But let me go back to the business models. So the old guys, my girlfriend's dad, passed away at about 96 after drinking a bottle of ouzo every other day. So I'm pretty impressed by the longevity. The sons took over, the daughters took over, and they said, here's what we're going to do. We're not going to buy more ships when we're making a whole bunch of money. We're actually now going to pay dividends, and we're going to pay off our debt. Because, oh, by the way, Chris, when old George went to go buy the boats, he didn't really pay much in cash. He put like 10% down, everything else he borrowed. So now they've gotten religion. It's just like Devon Energy, just like the guys in the natural gas, EQT, all those guys. They finally said, we're not just going to keep buying more stuff like Aubrey McClendon, back in the day. We're going to manage our reserves, and just like in the shipping, we're going to upgrade our boats, because in this year, there's a new environmental law that says your boats have to have scrubbers on them. If they don't have the scrubbers to scrub away the bad air, the pollution coming out, they have to lower their speed to 3 nautical miles an hour. So now you have 3/4 of the ships have to travel at 3 miles an hour because they don't have the scrubbers, number one, because the Greeks are notoriously cheap and it costs money to do. Then the second thing is, if you're going, the other guys are going 12 knots and you're going 3 knots, and now you have to go twice as long, it's going to take you a month to get where it used to take you to get in a week and a half. You're going to tie that boat up, which means the ships with scrubbers, which Ardmore has scrubbers on every boat, can pick up every job they ever want, and they can charge whatever the hell they want for a good amount of time.
So what's the stock that they use to leverage that, to take advantage of that? Is that BDRY, or what are we looking at? What are we looking at?
Well, for the tankers, for the tankers, Ardmore is one. They're a pure tanker play.
Symbol?
Well, Ardmore, ASC.
ASC, right. Oh, ASC.
And I see what you're doing. Yeah, you're going to see a highly correlated. What do you think?
All right.
Then if you look at BDRY, which is the bulk shippers, the guys who ship coal and oats and all that stuff, and then put SBLK on with BDRY, you'll see that it follows it very closely. It's not 1-to-1, but what we're looking for is when it holds support and breaks support on rates, that means that the shippers have leverage over the people who rent the ships, because again of lack of supply. China reopening, they also had a strike against Australian coal, if you can believe it or not, which was where they got most of their coal. They got a little pissing match. So now they said, now we're reopening, we need a whole bunch of iron ore to make steel because we've got to start this economy. So all of a sudden now, so look at BTU, which is a coal company.
Do you think this is a bullish play?
Yeah, this is a bullish play because they benefit from China ending they're the largest Australian coal company in the world.
Well, all right. So I want to talk to everybody that's listening about this. Obviously, we've decided to join forces with Tobin Smith, and it takes some time to put together the services and the products that ultimately will be offered to our followers. And we want to do it the right way. We want to do it in a nice, polished way. You saw we recently did a relaunch of TrueMarketInsiders.io, and we're working out some of the kinks because it's a new platform and a new site. So what we were going to do, we were going to wait perhaps 60 or 90 days or so. 60 days out, I think, was the target in the middle of May. And we were going to approach everybody and say, we are opening the doors now to the greatest service you ever had a chance to sign up with. But we started working together, and all of a sudden a bank crisis happened where it's like every 20 minutes there's new news coming out and people don't know what the hell to do. And people are kind of running around with their hair on fire. And we decided that, we might want to do kind of a quick and dirty version of a service, something that will ultimately become your service, which will ultimately be Transformity Investor. And we found a way to basically pretty much, in a sense, give away $502 to anybody who's willing to participate here today.
Can I sign up 10 times?
Oh, yeah. Let me first, before I present this to everybody, let me first ask you to give just maybe a 1 or 2 minute description of your investment process. I know you've got a big Rolodex, you've got connections all around the world. I know a lot of times what's going to happen before it happens. A lot of the times that is because people with a lot of money are listening to you, and as soon as you open your mouth, sometimes it moves markets. I want you to give a description of your investment approach outside of just having all those great contacts. It's a transformative approach. You've talked about deglobalization. Why don't you talk to everybody about what it is that you do to come up with your investment thesis and how you act on what you find.
All right, I'll make it quick and hopefully painless, but let's just go back to December 2020. I get a Telegram message, encrypted, from one of our network members who says, "Hey, Tob, this guy happens to be a Micron engineer in China. We just closed 6 of our plants, and we closed 6 of our plants because everybody's sick here, and this COVID thing is a lot bigger than the Western media is presenting. And thought you want to know this." So I said, "Thank you very much." Made him a lifetime subscriber, by the way, and we went to cash in January, and we shorted energy, and we shorted the QQQs. And we got as much of our subscribers as we could twist their arms, particularly in their tax-free accounts, to get ready because the storm was going to hit. And I believe that we were one of the first people to. Now, I didn't publish this publicly for obvious reasons. I wanted our subscribers to benefit, but our information network gives us a head up on big stuff, not little stuff, big stuff. And so we went short, and we made stupid money, right? Probably up 400%. We're up 380% for the total year. Now, the other one we got was, I'm deep in the energy space. I was one of the first energy investors in Royalty Trust back in the early 2000s. I saw some old ChangeWave people there. And so there's these things called MLPs. I know you know what they are, but that's not the most exciting thing in the world. But when you're an MLP like USA Compressor, that's owned 49% by ET Transfer, which is only an $80 billion MLP company, and your stock goes from $12 to $3 in 3 days, down actually from 30 days when the pandemic hit, and they've never missed their $2 annual dividend. We were very excited to buy it on April 6th, I believe. We bought in around $4.50 to $5.
What year? You say 2020?
2020.
Yeah, April 6th.
Look at that.
Yeah, right here.
You got it. This stuff happens, Chris. We make the transformative research approach makes the most money when the caca hits the fan, when there's major transformational change. So what we've done now, we still own the position, but then with our all access group, the group that we have in our Discord rooms, that we sell call options or usually put options to generate more income. Because when it was up here, I would like to buy more at $7.50 if I can. So we sold $7.50 puts about 3 times. There's a customer of ours. His first name is Eric. I'll say his last name is B. Eric B sent me a note. He's also a wealth management client, and he said, "So you realize that my cost basis?" He loves selling put options. His cost basis on USAC is a negative $3.50.
Like a lot of premium on the way.
Yeah, he gets $2.25 in dividends. So you tell me how to do the math on that. I don't know how to do that, but we had very similar with a variety of MLPs. Well, how is that? Because the CFO I know quite well of many of these companies. Look at AMZA, AMZA. Jay Hatfield is an old friend. He is the money manager of ETFs. And you look at that. When they got down to the point where the AMZA was selling at, I don't know. Then go back to 2020, April 2020. Yeah, they got really cheap. And here's an interesting story about AMZA. I'm giving away a little bit here, Chris. Okay.
Not too much.
Okay. Well, this is the largest position that many of my clients and many of my subscribers own, because go back farther. Go back to 2014. You're going to see something you can't believe. That's where they raised money.
Oh, wow. Okay.
So when all that kept going down,
long term.
Yeah, the stock has to go to $76, Chris, before you'll ever pay any taxes because they have a loss carry forward. I'm hoping to
explain that a little further.
Okay, so because people were redeeming, they took losses. Look at all the volume. When they took losses, it stays on their balance sheet, and you can apply gains against those losses. But doing the arithmetic math, Jay Hatfield, the manager, tells me, and by the way, he put like 10 million of his own money in when he first launched it. God bless him. Can you imagine going to Thanksgiving over those years? So he says they have to get to $75 price before you would pay any taxes on their distribution, which is about 10%.
I see. Got it.
So this is a great example. We do great when the world goes to caca. We also do great when there's a geopolitical transformational change, obviously the Ukraine, et cetera. We're now in the deglobalization change. I call it the Rexit, the exit from Russia. And so that's why, we have recommendations in LPG. People don't understand that liquefied petroleum gas, you can't run an oven in China or in India without LPG. You may have the big tank outside the Safeway store.
Mm-hmm.
They have 180 million of those tanks in India. They have 340 million of them in China because they're richer. They don't have any propane there.
All right.
So there are transformative events create supply-demand imbalances, which creates pricing power. And when we find those, and particularly when we find them before everybody, we make a crap load of money. I'm just and that's it. I'm not giving anything more. You got to become subscribers.
They can get another 13 trade ideas, another 13 investment ideas with a report that you have finished writing about an hour before we began today. So the people in our design team are putting some finishing touches on it to make it look nice and shiny. But we have 13 investment ideas that folks here can get today. Now I'm going to explain why it's possible to, I said, quote, in a sense, give away $502 to anybody who's on this call. I'm going to explain. If you sign up with Transformity today, and this is a pre-sign up, if you want to buy a Lamborghini, if you want to buy that new hot car, there's a lot of things that you have to wait for. We're going to launch this service the way that we intended to sometime in the next 60 days or so. And by the way, the 60-day guarantee begins when we do the actual product launch, not the pre-launch. So you've got an extended guarantee. I'll get into that in a minute. But as soon as you sign up today, you're going to start to get 2 exclusive pre-launch benefits. First one, weekly write-ups from Tobin with recommendations a lot of the time. Okay, now when he doesn't force recommendations, it's one of the things I love the most about his services is that he doesn't go out there and force a recommendation just because it's Monday and he needs to get you your Monday, recommendation. Instead, he's going to tell you when the timing is right, but it averages out to something around once a week, but you're going to get weekly write-ups either way. And whether they have recommendations in them or not, most likely they will. You're going to have market research for sure. In the wake of the Silicon Valley,
thank you.
Bank crash, a lot of people are wondering whether we're at the brink of another 2008 financial crash. So Tobin, to help people navigate these concerns, is going to be putting out these weekly write-ups on the banking collapse until the launch of Transformity Investor. That's going to be in May. So more than that, he's going to be issuing recommendations to help people navigate and profit in the markets ahead. His followers pay him hundreds of dollars for this kinds of research very, very easily. But pre-sale members can get it for free. So you're not going to pay anything for that today. Sorry, Tobin. No revenue for you. Benefit number 2.
No, what is it? You want to eat the soup Nazi? No soup for you, Tobin.
No soup for you. All right, you're going to get the Transformity Banking Playbook 2023. This is hot off the press. It is still warm. It has a $199 value. We're going to be selling it in some places for that sticker price of $199. But you guys today will get it. If True Market Insider members, if you're a True Market Insider follower, if you're somebody who's subscribed to the True Market Insider's e-letter, then you will have access to this. So anybody who signed up today is going to have access to a brand new report from Tobin's team. You're going to get it completely free. Instead of paying $199 like others, you're going to get it completely free. It's called Transformity Banking Playbook 2023. Again, he just finished it. It's so new that we put an extra set of quotes after the year 2023 there. We don't have time to clear up mistakes over here, right? We're just going. This thing is moving fast. So the report's going to cover the upcoming banking crisis, all right? Not just the one that we're in. What's more important is not explaining what's happened up to this point. I mean, it's nice to have some clarity on that, but what's coming in the future is why you need Tobin on your side. Ways that you can use this banking crisis to profit in the months ahead. Tobin says it. When the caca hits the fan, that's when you want him in your corner, because he's the guy who goes out and buys these things before I do. I'll tell you, I'll be the first to admit it. I don't buy at the bottom. Tobin buys at or near the bottom a lot of the time, and you can expect to receive this report in 48 hours. Again, there's 13 trade ideas. I shouldn't say trade ideas, investment ideas. Some of them could turn out to be trades. You're going to get full membership benefits. So all of the things that we're going to talk about are going to become available in May, when Transformity Investor launches in full. Just to be clear, if you sign up today, you're going to be signing up for something that launches in May. You're going to be getting a steep discount because of that. And you're also going to immediately start to receive weekly emails from Tobin. So it's going to be very much like the service. It's just not going to have the really cool website all prepared for you. But you're going to get the information and you're going to get it at the right time. We're not going to wait. We're going to do it now when it's necessary. So benefit number one, you're going to get 12 monthly newsletters. These newsletters are crafted by Tobin and his team to help you take advantage of new and emerging transformative opportunities. So every month, you're going to learn a new way to play these massive transformative trends, complete with a stock pick directly from Tobin, as well as his detailed analysis. Benefit number two, our complete Transformity model portfolio. So Tobin's complete Transformity portfolio will include 7 stocks set to soar thanks to massive trends in America and beyond. Right now, those picks, those stock picks are being finalized. So you're going to have a model portfolio with lucky number 7. All 7 picks will be released to Transformity investor readers when the membership launches in May. Again, you're signing up early today. When you sign up early today, you're going to get a steep discount. So that bundle, which benefit number 3 is valued at $500. This bundle of reports is going to give you detailed information on some of the biggest mega trends of the coming 10 years, setting you up for financial success for years to come. Remember, Tobin Smith is not somebody who you had access to like this up until now. All 3 of these reports, by the way, are going to be delivered to your inbox within seconds of our formal launch in May. Right. Again, just to be super clear, you will get within the next 48 hours of pressing submit or whatever the button is when you sign up with Tobin. Today, you're going to click that button, and within 48 hours, maybe within 24 hours, depending on how quickly my team gets the report sent out, you will get the report that has 13 trade ideas. So I think we've probably given you, or Tobin's probably given you 10, and I'll review those 10 that we went over on this call in a moment. But you'll also almost immediately get another 13. All right, so this number 4 benefit, you'll get SMS alerts. So the markets are moving fast right now, and it's hard to stay. Yeah, I know. I mean, you miss the email alerts. Sometimes they go to the spam box or the promotions folder. Is a misunderstanding.
You're traveling. You're working.
It's buried. I mean, I barely look at my email. I most of the time I need somebody to text me to tell me that they send me the email, and I go do a search in my email. I've got thousands of emails. I look at it like physical mail at this point. I have to have somebody else go through it and sift through it. But the markets are moving fast right now. All right, and you're going to want that text message. You're going to want to feel that phone vibrate in your pocket and then look at it immediately, because sometimes if you wait another couple hours, it might be too late. So you're going to get SMS alerts. It's hard to stay on top of everything. So the team sends out SMS. If you guys don't know what that means by now, it's a text message basically. Whenever there's major moves in the market.
Well, so, and Chris, not only that, but also when we add, I've been wanting to do text for a while. We have, the way, because, when we put a stock pick out, shockingly, they move pretty quickly.
Yeah.
So if somebody wants to, get it at the low end price, you got to get the text and you got to open up your app.
Yeah.
And buy it. So I love this, man. That is awesome.
And let's also make something very clear, guys. You don't expect to reply to that text message and then start a text chain with Tobin. It's a one-way street. That he's going to send you the texts, but you're going to get Tobin's timing. Okay.
Thank you.
Look, when markets and stocks and these banks that are actually very healthy but are being punished with the industry, when those things get cracked, right, and they trade down, sometimes 5 times faster than it took them to trade up to that price, they snap back so fast that you need to be on top of these alerts. You need to get the alerts fast, and most importantly, the sell alerts, the exit alerts. So you're going to get an SMS message if you opt in for it.
I love it.
You're going to get a US-based customer service team, which nowadays is very nice to have. If you ever have any questions about your membership, reach out any weekday, 9 to 5 Eastern, to the US-based customer service team, and you'll have the number, in your email, so you don't have to remember it here or anything like that. But they cannot provide any individualized or personalized investment advice. They're always happy to address your concerns or answer your questions. You're going to get a 60-day risk-free refund policy. But like I said,
all right, Rowe, you got to stop this. You're giving away the freaking store here.
Well, look, you're also going to, there's even more than this that we're not even listing here. If they want to get the full package, the big shebang, and sign up with your Discord room, and which they're on with you live, and they're talking to you all the time, there's another level of service there. But all the different levels of service that they're going to be able to choose from today have been steeply discounted because you are buying it ahead of time, and no one else is going to have this kind of opportunity. So the 60-day risk-free refund policy. So you can lock in your Transformity investor membership today, no risk.
Woohoo.
In fact, we're going to give you 60 full days to test drive his research. And by the way, you're going to start getting emails weekly as soon as you sign up. So this week, next week, the following week, leading up to the big launch, you're going to continue to get emails from Tobin with stock picks, stock ideas, research, estimates, so forth. If you decide that this is not for you, you can call the US-based customer service team anytime in the first 60 days of your membership for a full refund. We want to make sure that you get your representation here nice and early, nice and cheap. So what I'm going to do also is I'm going to launch the offer button here. Let's see, start offer, publish, and hopefully you guys are seeing a little pop-up on your screen. If you want to tell me in your chat whether or not you're seeing that pop up, I want to make sure you see it. But the limited time pre-sale offer at Transformity Investor. Now, just so everybody knows, the pricing that we put in here, we're giving you half off of a, in the future, we're gonna offer at a discounted price, but you're getting half off of the discounted price. So basically, the basic package, 1 year, $97 is the price of it. That's already discounted, $97. But we're gonna take that a step further, and we're gonna bring it down to $49. Let's see what the order form looks like. Now, just to make sure everybody understands, you just click into the box that best suits you. So the basic package, usually after we discount it, it's gonna be $97. We're gonna discount the discount, bring it down to $49. And that includes the weekly newsletters and recommendations, the bonus report with 13 trade ideas that you're gonna get sometime within the next 24, maybe 48 hours. Probably get it, tomorrow latest, but that's $199 value easily. These are not stock tips from some, overnight YouTube sensation. This is Tobin Smith, guy that talks to the wealthiest money managers on earth, some of the biggest business managers, CEOs, CFOs. So the full membership benefits in May are going to be 12 monthly newsletter issues. Okay, so you're going to have weekly issues leading up to May, at which time you're going to have 12 monthly newsletter issues. You're going to have SMS alerts. You're going to have Transformer Investing Bundle, which is a $500 value, and you're going to get that model portfolio. Again, that's 7 stocks. Very easy to manage a 7-stock portfolio. Also, you can get the VIP package, which is lifetime. VIP package lifetime, $249. Now, post-launch, we're going to kick that up to $397. And again, that's going to be a discount from a higher sticker price. But we're going to launch, as we usually do, when we launch a new service, we give a discount. So the reason I keep saying it's discounted off of a discount is because anytime we do a launch, we give a discount. So in May, we're going to do a launch. So it's going to be discounted, right? Today, you're going to get an even further discount. So that's why I'm saying it's a discount on top of a discount.
So you're saying I have to live about 10 years here to make this all work?
Hey, that, like I said, this is a lifetime membership. So what we will say is that if it's either your life or Tobin's life. But even if it's whoever's life it is,
there you go.
Whoever's life it is, we will, you give us a call, assuming it's Tobin's,
well,
and we will put you in something else.
I got a good 15 years, crew. I got a good 15 years left.
Well, yeah, the happier you are, the low stress you are, the longer you live, and you strike me as a low stress kind of guy. And then once you sign up with this, right, you click on the box, see how the box changes color. You click on the box, you make sure you lock in your subscription. Yeah. And then after that, we're gonna make an additional offer to you. After that, there is a Transformity Research Live Club Room add-on. So you see this add-on down here in yellow. I just clicked on it; it turned blue. Normally, it's going to be, again, when we launch this, we're going to launch with a discount. So that's going to be $997. That's actually a discounted price. But if you do it today, you could do it for $495. So we're giving you half off of a discounted price. And if you think about it, would you buy a stock right now if I told you that I guarantee you it's going to double in 60 days? If I told you I guarantee you that the stock is going to double in 60 days, and I handed you the money, and I said, look, that's my guarantee, you're going to just have it, you would do it. Well, I'm telling you right now that you can buy the discounted price half off. It's the same thing as doubling your money. It's the same thing as doubling your money with a guaranteed upside in 60 days. So again, this is educational. He speaks in an educational way. Sometimes he's going to be talking about stuff that's going to be hard to follow because he's an analyst. But at the end of the day, he's one of the most fun people that's ever been in the industry to work with. Everybody knows his reputation. I remember hearing about you. When I wrote the business plan for my first investment research firm, Tycoon Publishing, you were somebody who we really highlighted, wrote a lot about you. And we spoke primarily about your personality and what you bring to the table, not only the analysis, we talked about the show and everything, but your personality. We know that the seminars, when you go see Tobin Smith, and it's you think some financial seminar for some financial guy, you end up in a vineyard. So you tasting wine and partying, and every now and then you take a stroll with Toby and you talk about the stocks. But he's a fun dude.
Cool.
So this is what it looks like. I popped up the let me just go to the chat to see if you guys see that that button there. Let's make sure. Okay. Alliance members will give you a call because I see there's some some questions about that. So we'll do that. But I just want to make sure you guys can see the button that I popped up. So the offers button, the order now. Let me see if Melissa, if you could text me just to tell me that it popped up. Let's see. People are okay. Nice. Well, looks like people are really scooping up their subscriptions here.
Awesome.
It's no offense, Toby, but it's even better than I thought it was going to be.
Hey, Chris, I don't know about you, it's like martini hour here. At 5 o'clock we ring a bell here in Scottsdale.
Oh, did you Scottsdale?
Scottsdale, yes.
All right. Well,
this is going to be a lot of fun, and I gotta tell everybody. I'm just reading some of the notes. There's a fair amount of ChangeWave subscribers.
Mm-hmm.
When we sold ChangeWave to S&P Global, they fired me, Chris. It was very hurtful, but we did okay. And then I had a non-compete for like 2 years that I sort of messed up and made it into 3 years. So when we started again, Transformity Research, we took everything from ChangeWave, but I didn't add in, the technicals and stuff. To meet Chris and to see what TMI is doing, when you combine our sort of boots on the ground research, and then can add some technicals to it with, the services you sell, that's hard to beat, boy.
I think we complement each other very, very well. Between the technical analysis, I focus primarily on price behavior. If I'm going to make a long-term investment, I'm looking at the fundamentals of the company and everything. But the way that you see the markets, I mean, way before I'm able to see it, is always fascinated me. And I've always wished that I could, with the technical analysis that I bring, I've always wished that I could deliver the explanation that you do. That you see the market so clearly. When I say when I teach people how to invest and I teach technical analysis, what I tell people is that it's about seeing the market clearly. If you can use the technical indicators to first see and understand what's happening, if you can use some sort of categorization process or some framework, an investing framework, to see what's happening to the market, where the strength is, where the weakness is, that's key. And then you can just adjust yourself accordingly, because whatever's happening right now is likely to continue happening. That's my philosophy, is that you're betting on the fact that trends trend most of the time and they reverse some of the time. That's my philosophy. So we're going to bet on the idea that this trend is going to continue for some time. And then when it doesn't, we're going to shift and we're going to use risk management strategies on top of that. With you, it's a little bit different. With you, you're making money on those big moves that happen on the reversals. So for me, I wait for the reversal to happen. I wait for the trend to be in place, and then we ride that wave. And with you, it's transformity. So with you, it's when you see a trend change from something getting clobbered down to the pennies, and then all the short sellers that were making a lot of money on that decline come in and they close out their positions. They do that by buying back stock, and all that buying pressure sends these stocks trading up multiples higher. And you're today showing us some stocks that are paying with 14% dividend.
They're gonna get some in our existing portfolio that pay significantly more than that because of these new business models. My favorite still is Amza. It's not paying a 28% dividend like it is based on when we got it, but we mix. Also the world has changed, Chris. If the Fed is not making free money to everyone and flooding the market with $6.5 trillion of cash, we're sort of back to the future a little bit. You actually have to understand an industry, understand that the industry is going to continue to grow at a much faster rate than the overall economy, but that also that your return is going to be not just from capital appreciation, but also from dividends. And many of our stocks pay dividends and have capital appreciation. And then when the caca hits the fan, that's going to be my new T-shirt. Then we have an opportunity to just buy what we're already buying, own what we're already buying, but buy it at 50% off. And the things that we buy are long-term trends, and then every once in a while you get something like that happened the last 5 days, and you get a big opportunity. But the people back from when we got the note about the COVID reality, Those people made 42 years of wealth in 22 months. Now, I'm not promising anything here, ladies and gentlemen. All I'm saying is that when you have the finger on the pulse, as I always like to say, I actually am a true market insider. When you actually can take advantage of these opportunities, then man, it makes life better.
You said it. I really want to point out, I want to highlight what you just said, that you really are a true market insider. That name means a lot to me. The way that I
didn't realize it until I really got to know you.
Yeah.
But we have about 1,200 people in our information intelligence network from all over the world. I've been in 45 countries. I'm older than 60, so I've been around a little bit. And it's just been amazing to me how these things have turned into, these relationships have turned into, huge money-making opportunities. And it's just, I hate to say it's trite, but you're not going to hear this on CNBC. You're not going to hear this, from some of my former editors that I used to publish back in the old days and so on and so forth.
Let me dive into that for a second, because that's really important what you said. The mainstream media right now is just, to me, it's manipulation, it's propaganda. It used to just be that they're manipulating you to be excited and keep your attention and do whatever they can to sell ads. But now it's like, it's like the deep state, it's the deep market. And there's certain things that they have to agree on saying. You've been on television for a long time. They've got the little earplug, and they might yell at you to stop talking about something, or they might yell at you to tell you to argue with somebody about something. And this is no filter, uncut, raw Tobin Smith mind. And I want you to talk a little bit about the Discord channel, because that Discord channel is huge. There's a lot of people that can benefit from that Discord group that they might not be users of Discord. The Discord might seem like something that young kids use that they can't get their head around, but you use it, right? And you're no spring chicken, are you?
I'm young at heart. So the Discord was originally created for gamers, and it was originally created. It's a platform where you can have a voice, digital printing, pictures, so on and so forth. It's sort of like Slack without all the other stuff, right? And but what it allows us to do is, I'll just, I posted a couple of things to the TMI people. A lot of my network people are also subscribers, also check in. And we got the note from one of our intelligence industry members, shall we say, about the Russian invasion in mid-January. And we're able to prepare for that. And that's how we were able to, be buying fertilizer companies, because most people don't understand that natural gas is what makes fertilizer, and that Russia is the biggest fertilizer manufacturer in the world. We were able to buy, obviously, natural gas. We were able to buy LNG. We were able to buy LPG. We were able to buy FSRUs, those boats that Germany just has leased everyone in the world that sit offshore, that allow them to take the LNG gas off of the LNG plant or the LPG. All that stuff happened because of really two people that were deep inside the intelligence industry. And it blew my mind. I don't know, maybe another 10 years if something happens, but I don't think so. The world moves too fast. So that's our sort of extra edge for the stupid money. For just making the regular money, one of the first things I'm going to publish are essentially the 15 micro sectors of the world that have secular winds of demand that we're starting to look to buy companies in. But in the Discord room, it's all real time. And many times what happens is we're able to put out a option trade, either to actually buy the options like we did last week. We bought the UVXY going into, this is the 2X VIX.
Yeah.
ETF, and we were able to get options on it for $4 and sell those for $42.
Wow. Until you did that in the Discord channel.
Yeah, but it's the only way you could do it.
And what's so walk me through that. Walk me through what happened there. And I lost the screen. Hold on a second. So UVXY, and I'm gonna zoom in.
Go down here
for you. Let's just go to the hold on a second. Let me get you a better chart here. 6 month chart. Okay, so this thing went from 434 to 7 and change, but you actually traded the options. You recommended the options in the Discord room, in your live, in your private room.
Right.
Okay, and so that's a quick trade. They had to be on that immediately.
Yeah, exactly. Things were moving so fast. The option went from 55 cents to $1.50 in about 3 minutes. I mean, look at that. Well, it went from like 55 cents to this was probably the March 27th to 55. It went up 14 times. So what does that take us to?
55 cents 14 times.
Yeah, and remember, and the other thing is you got to know when to sell. So you see that green stick, we start putting trailing sell stops on it, so we closed it out. So again, I think basically we got it at 55 cents. We sold it at like $11.20.
11. And how long? A couple days?
That was a day and a half.
A day and a half. All right. So that's the benefit of being in that Discord room. And so 14 times your money in a day and a half. And let me just show everybody on this order form. If you click the link in the chat on this order form, you scroll down to the bottom, and you can do the $49 thing. You can save yourself $50. That's nice. You could do the $249 thing and get a lifetime membership, and that's cool. You save yourself $249. But if you scroll down here and you get into the live room, you save $502 on this. And again, that's going to be off of an already discounted price.
Yeah.
And again, you took a trade within a day and a half that made 14 times the investor's money. So I would say that that's worth $495.
Well, obviously, they don't all go that way, but trust me, when the caca hits the fan, to stay with our theme here, and we're ahead of that. I mean, the money we made on Moderna from our insider at the FDA was same thing, where we get a message from him that their mRNA was basically ready to go in the end of January. We were able to buy. Again, I don't have the chart in front of me, but we made another 1,100-1,200% gain on it. As remember, the Moderna went from $50 to $300. Well, when you own the options, you do a lot better. So it's a great mix. But the other one, I go back to Eric, who has a minus $3 cost basis in his USA compressor. Just knowing when to sell put and calls, for income. That's no brainer. I mean, that's like. In my private account, if I make more than $1,000 in premium for the day, I buy myself a nice bottle of wine, Chris. That's how I reward myself.
Well, that's healthy wine.
Yeah, it's healthy wine, and my wine cellar is completely full. So that's really the statement.
Yeah, you have a legendary wine cellar, actually. Everybody in the industry knows about the Tobin Smith wine cellar. But that was in Virginia. Now you're in Scottsdale, so I don't know.
That was in Bethesda, Maryland.
Did you upgrade the wine cellar, or is it you trade down?
I've outsourced it.
You've outsourced it.
I don't have a basement in Bethesda. Two people really need a 7,000 square foot house, and so when we were building the basement, I'm kidding. When we were building the basement, I said, "Well, God, we're going to put a wine cellar in here," and 3,500 bottles later, it was great. Now, here's an interesting one. When we moved, there was a lot of big Jeroboams and double Jeroboams and all that stuff. So I got a wine broker in. And he sold the 10 Jeroboams because, frankly, I am too cheap and Scottish to drink a $7,000 bottle of wine. I get no pleasure out of that. He sold them for me, and I got a 3 times return on my investment in my wine cellar. I just love that.
You're a great investor.
I just love it.
I'm excited to have you. I got to tell you, it's I'm excited to have done this. This is something that we decided to do this pre-launch yesterday.
Yeah, I know. I love it. I love the way you guys move, man.
Yeah, I mean, look.
Phillips Publishing, we would have been having meetings for 3 weeks.
I know. And that's what we wanted to avoid. The moment is now, and it would be like 2008, waiting a few more months to launch the thing. The first time that you and I did business together, I mentioned on a recent webinar, is when I launched my first technical analysis course. This is written in 2007, pretty big one. So, and then, we basically did a sort of a deal where you would talk to your followers about this technical analysis course.
Yeah, I know. I asked my old publisher about that, Dave Durham.
He's the one who hooked us up. He connected us, and I met you, and I met him at the Money Show, and then we talked to you about what it was going to teach. And it wasn't just technical analysis, but we were saying the market is topping out. It's 2007. I started writing the book in the beginning of 2007. It's all about the market topping out, how to take advantage of the bear market, and we crushed from 07 to 09 as the market just got clobbered with put options on all the financials, call options on lots of commodity stocks. And you told your investors, your followers, that they should sign up with me. And we had a huge response. You were the single most followed and subscribed person in the industry.
Well, at that time, we had 250,000 subscribers.
Yeah, a little bit more than we have here. I think you had 250,000 paying subscribers.
No, we had 250,000 on our free wave wire, which we're now just starting.
Okay.
And then we had, I don't know, we had like 100,000, 120,000. I can't remember.
Well,
I just cashed the royalty checks. You know what I'm saying? I don't know. I never.
Well, at the same time that you told your followers about this technical analysis course and my teaching them how to profit from a bear market, you were also talking to your subscribers and then my subscribers about the market coming down. So there was a time where you marketed to my guys, I marketed to your guys. And so for that bear market, there were a lot of people out, thousands of people out there that used my technical approach and your macro approach and basically had the two of us guiding them at the same time.
And they made money.
Perspectives and made a shit ton of money. When you
make
money
like that,
you got to be
late.
Yeah. You got to be quiet when you make a lot of money on disasters while everybody else is feeling the pain. You have to go celebrate with one friend or something like that. But now is the first time since then that people have a chance to do that again. We complement each other well. We're going to be on lots of webinars and podcasts together in the future. This is the beginning of that relationship, and it's actually the pre-launch of that relationship.
You know, again, going to your point there, the story I told about the senators coming out of the meeting saying that if we don't I have never seen people look so scared. And when we saw that, and I saw that, I'm on my bricks. I'm on my BlackBerry. And I'm telling the editors, I'm coming back, and we're going to put out this alert about what's really going on. And then 2 days later, they reported, that the TARP was going to happen. And that was not inside information. I was outside the room, but now it's a lot easier to be inside the room because you can be inside the Zoom, you can be inside the Meet, you can be inside the I get a lot of my information still from Telegraph and encrypted stuff. I mean,
a lot has changed since the old days here, huh?
Yeah. Oh, look at this! Now they throw some pictures up. Oh my gosh!
There's the bulls and bears.
Yeah, that's actually the launch day of FBN. We launched FBN. That's Liz Claimer, my little Lizzie.
Fox Biz.
Yeah, we launched on the top of the market, October 8th, 2007.
Do you know I was helping that happen kind of behind the scenes. I had a friend who was working on that launch there. That's how we got Tika Tiwari for the first time. We got him on Fox Business. Yeah. So our guys started getting on Fox Business. But I remember when they were doing that launch.
It was interesting because this is before it became a political thing. It was just trying to be a business show against, to compete against CNBC, and Neil Cavuto is the head of it. And I've known Neil forever. I know Neil from LA, from the financial news channel and channel 22 in LA. But FBN, and then they finally got rid of my show, America's Nightly Scoreboard, because all they had to do was replay Lou Dobbs ranting and raving. That's a good one.
Yeah. What about let's see. I guess Bill Colbert was interested in talking about you at one point.
He did a whole episode. I mean, did a whole segment. And I love Stephen Colbert, by the way. But he did a whole episode while the world was crashing. He was saying, "Why is this asshole smiling?" And he said, I'm a horrible insider elite. He threw every name in the book at me. And then he sent me a text afterwards. He told me, "Listen, I got to tell you something. I sort of went off on you, and I hope you don't mind." I said, "Hey, man, any publicity is good publicity, brother."
Let's see. What else do I have here?
We're getting a warning that we've been on for 2 hours, and that means I'm a half hour after my martini.
Yeah. You keep on hinting that you want to go, but I'm not letting you go. I'm going to look at one more picture with you, and then we can. I want you to tell me what this is, because this is one that I just found in the pile. What is this?
Oy. So this was basically just before I had a interview with George Bush, and this was all during the financial crisis. But the funny thing was, I'm a little embarrassed to say this, but the producer who hooked us up or got the meeting interview said, "Well, he says, I do a George Bush imitation. I know you're a comedian, right? But I do imitations." And she put me on the phone. And I said, "Hey, George, this is George." And she said it was okay to do. I said, "I'm going to call him Mr. President." And she says, "That's pretty good." So I got the interview, and I did not make fun of him, nor did I do it. But it was a big interview. it was a big interview, and it's the thing about George Bush is that he was so malicious, right? He would butcher words and sentences like nobody's business, so everybody thought he was a pea brain, but he wasn't a pea brain. But what he was he had a bunch of older guys that were his dad's friends and who influenced him, and he never got out of the shadow. And 9/11 happened, and he really stood up. And I lost multiple people. I know you did 9/11, and we did a special 3 weeks after with Joe Battipaglia. Remember Big Joe?
Yeah, that Big Joe Battipaglia. Yeah,
and Batman. Ones. And he called in. He called in and said, "Hey, I'm glad you're doing a memorial here," and so on and so forth. So, nicest guy in the world. We like to say Lucky Sperm Club. There you go.
Yeah, that was right around the same time as the President's Dinner 2008. So that was in the first half of 2008. I remember going there, talking to I have another picture just like this with Dick Cheney too, but a bunch of the congressmen, and the one out of Dallas. I'm trying. His name always slips my mind. And we were talking about the mortgage crisis. We were talking about the coming crash, and we were sitting at the table with senators and congressmen talking about what is likely to happen. And surprisingly, I don't know if they were supposed to keep a poker face on or what, but they didn't really seem like it was being really too strongly considered, and not at the level of that it probably should have been. I've got
I have this theory, Chris, and based on what I've observed over the last 100 days or so, that if you're an analyst or a money manager, and you didn't live when I bought my first house with a 19% mortgage because the Fed funds rate was 19%, and you can't believe it. If you didn't wait in line for 2 hours to get gasoline because the Arab embargo had locked up all that, you wouldn't believe that you could get inflation like we have right now. And I think a lot of people just completely underestimate how hard it is to get inflation down. And I remember sitting in front of pensions in like 1982 saying that I can put together a portfolio of 15% 10-year and 30-year bonds for your pension. And people would say, they're never going to work. And those bonds, I remember selling one pension plan, $10 million, it was a round number, $10 million. Those $10 million of bonds paid out a 15% yield, so $1.5 million a year. And the value went up to something like $120 million. I mean, you got to live through the crazy, in my opinion, to really understand the crazy. That's an old memory I hadn't thought of in a long time.
We're gonna just another few minutes. I just want to make sure this. Some people are having trouble with the purchase and everything. So I just want to make sure that everybody knows that they can contact us at the number that I'm going to pop up on the screen, or they can also contact us at support@True Market Insiders, and somebody will we'll get back to them pretty quickly, probably latest tomorrow. Let me just pull this up, and then the last thing I'll do is go over some of the trade ideas that you were kind enough to share with us today. One last time for those that signed on late. But again, if you want to contact us, toll free, it's 855-822-0269. Again, that's 855-822-0269. That's the toll free number. Also, if you are calling from outside of the U.S., let me put that one up here. 001-561-206-1207. I hope you guys appreciate that we do this stuff with speed. We do it kind of off the cuff sometimes. It might not be polished, but our timing is pretty damn good. And I think
I'm very impressed.
That's why you guys sign up with us, is because of our timing. And we're not going to sit here and to make ourselves look beautiful, sacrifice $1 of profit or $1 of missed saving your losses. So you can contact us at the toll-free number. There's a little bit of an ugly slide here. Hope you don't mind. And the international number you can use down here if you want. And in just a moment, get this info down, because in just a moment, and you can always go to truemarketinsiders.com, truemarketinsiders.io now. You can scroll down to the bottom and you'll find our contact there. Some people are trying to purchase. We want to make sure that everybody that's on this chat that's saying that they can't purchase, we'll make sure that you do have access to this, even if spots are filled or anything like that. We'll make sure you get the discount and everything like that. But just make sure that you do contact us, you do email us, or else we're not gonna be able to do that. All right. So finally, let me grab this this list here again. It's not gonna be beautiful. It's gonna be a little Word doc here, but
no worries.
Give you the trade alert, the trade ideas, and you guys can jot them down. Maybe do a screen share. Let me shrink this a little bit so get it all on that window. Yeah, BTU is at the bottom and Schwab is at the top. So all I did was just jot down the symbols as we spoke. At the top, what you have here are, let me do this. At the top, what you have are banks, financial companies. So that's up here. And then down here, we're getting into commodities, energy companies, oil service, things like that. But up here, you have Schwab, Interactive Broker, PNC, JP Morgan. TFC is what?
TFC is Truist.
Truist. And NLY, which is a 14% yield.
Yeah.
And when you're saying about NLY,
when the Fed stops raising rates.
Right. And when the Fed stops raising rates, because the Fed raising rates causes NLY to move lower because it owns lots of assets that move lower when rates are going up. Correct. But it seems like we're coming towards the end of that because the Federal Reserve has done so until they broke something, and they don't want to cause a bigger crisis. They need to just do their job, stop saving face. They need to just do their job, not worry about their legacy, just do their job the right way, not raise rates too fast. And what are you going to do? You're going to lower rates to try to stimulate the economy, just to make up for the mess that you made. We don't want to get into that, but ultimately that likely ends up happening. Either they stop raising rates and then they eventually lower rates. That's when NLY underlying starts to move higher. Yeah. But it pays a 14% yield right now. So as it goes lower, that yield might go up. And you're going to want Tobin's timing on this. You're going to want to be in the Discord room. You're going to want to be on the SMS list. You're going to want Tobin's timing on something like that. And it's well worth it. It's well worth the cost of the subscription. If you're thinking about the cost of the subscription and that's a stressful thing, I don't think you should be in the stock market at all. But here you get a discount off of the discount, and think about the money that you save and think about the money that you make from having that access to Tobin.
Well, I will say, I don't know if you agree, Chris, but my research and just my analysis is that if the Fed does not, or in other words, does not raise rates on the 22nd, then the market is going to shit the bed again, because they've just said we're going to put $6 billion. We're going to guarantee all of these non-FDIC deposits. And implicitly, they made it sound like they would do that for any bank that has the same problem right now. So by doing that, they've put a floor underneath the market. But if they did not raise rates 25 basis points, what they would be telling the market is, we don't think it's going to work, and we're going to need to stimulate. Well, you can't have two messages at the same time to the bond market, because the bond market, that's where I started, brother. And the bond market is pretty binary when it comes to that stuff. And then when people started selling bonds, well, what would happen to the rates? The rates would go up, and it would be significantly inflationary. And you can make an argument that what they've done already here is inflationary. They haven't injected money into the system, but they've backed up money that that's going to remain in the system. And the last thing they want to be in the whole spectrum of the world right now is to be like, oh shit, we said we're not going to raise rates, and the market goes down, and rates go up because people sell out bonds because they have no credibility. They're in the box anyway. If you do the math, which I've been doing for the last 9 months, we have 11 million people available to work. 11 million jobs, maybe a few less now that Meta laid off 15,000 people. But we have 5.5 million available. We're missing about 6 million people, and we're missing those 6.5 million people for variety of reasons: COVID death, long COVID, no immigration for the last 2 years, people just retiring. You know that 45% of the people who went on Social Security in the last 2 years were 62. They pulled it early. We never had that before. That's 1.5 million people that put went on Social Security and were 62. If they waited to 66.6, they would get $1,000 more a month. We have 6 million people incarcerated in the United States, Chris. Those people aren't getting any jobs. I mean, we have a structural difference. And the way my math works is that the only way that you get labor inflation down, which is 72% of the economy, and we're a consumer economy, and that's 70%, is to kill about 4 million jobs. Either kill the job or have the job removed from looking. And that only happens when you have a recession. It doesn't happen when this idea of the no landing.
Mm-hmm.
That's one of the funniest things I ever heard. No landing. I mean, first off, I wish I would have made that up, but you don't get rid of 5 million extra jobs with a no landing. The way you do it is at the margin, good old margin, economics 101, that the restaurant guy says, okay, we're not going to hire that person. We'll make do, and we'll probably get rid of the other schmuck that I hired that I don't like anyway. And then, yada, yada, yada. And pretty soon, all of a sudden, service wages come down, and people are happy to take the. I should have sent you a picture from the Jack in the Box that I went to, Chris, last week. I'm sorry, I went to a Jack in the Box. And the sign I couldn't stand it. I drove by it, and all I was thinking about was that sourdough super Jack. Oh, so I roll in. They're paying $20.25 an hour to work at Jack in the Box.
Tobin, we've got to wrap up. We've got 30 seconds, and then the webinar jam is going to cancel us. So we don't want to get canceled. So everybody, go to followtmi.com, as in True Market Insiders, or too much information. Followtmi.com. And that's the web address, www.followtmi.com, to sign up with Transformity Investor at a price that is discounted to the future discount price. So it's discounted from the launch price